Want to say hi? There you go. That's the guy. My friend Joe Wong brought with him a couple of these very expensive and very nifty power chargers. So if you've ever been out in your truck, your battery dies and you're like, how am I gonna charge my phone? Or have you ever been trapped in an airport and all of the plugins are already taken? These charging things are really game changers when you need the electricity. You put it in your briefcase or your purse and you've got it with you whenever you need it. So what I'm gonna do is to encourage participation and the asking of questions, I'm going to just randomly give these out to people that make comments or make questions during the course of this presentation. I don't want to just be speaking at you. I want to have a conversation and make it interactive and more interesting. Does that sound fair enough to you? Yeah. Okay. My name is Jeff Peterson. I'm licensed as an attorney. I give a lot of continuing education classes. I've also taught tax law at Mitchell Hamlin Law School. I've taught a 4-credit course there, maybe 27 semesters. So I know a lot about the income tax and the internal revenue. But what I really know a lot about is Section 1031. Made my almost entire career off of that one little page in the Internal Revenue Code. And I am humbly administering exchanges day in, day out. I'm in the trenches doing the work. And because of that, I have real life practical experience to mesh with the theoretical understandings that I have as well. So let's just say I've stubbed my toe a few times. I've learned some lessons along the way. Those are hard-earned nuggets of wisdom, and I want to be able to share that with you today if I can. All right. Again, feel free to ask questions, make comments. We've got 2 hours to do this. We're going to do it. After we're done speaking, when the educational content is finished, I'm going to let our sponsors come back up one more time and just give a little spiel about what their particular services are, because I want to give them a little bit of sunshine and illumination. Almost 100 years plus now, in 1921, Congress faced a crossroads. We had just finished beating the Germans in what was called the Great War. And during that war, in order to fund World War I, we kind of ran up a deficit. And furthermore, we were taxing people heavier than we'd ever taxed them before. During that time frame, the highest income tax bracket ranged as high as 73% for income tax. Would you even get up and go to work if you were going to give away 73% of your hard-earned wages? I mean, that seemed almost astonishing, but there it is. And in 1921, Congress had an idea. They said, we can either continue to have these oppressive tax rates and try to pay down the war debt by taxing everyone heavily, or we can try to grow the US economy and increase revenues by broadening the base of taxpayers and the amount of velocity in our economy. And they chose the latter. Did they make the right decision? Maybe. As part of that legislation in 1921, we have the precursor to Section 1031. They didn't have a consolidated section of code sections that were just related to tax. The tax legislation was just mixed in with everything else. It was a hodgepodge of legal legislation. In 1921, they had this first provision that allowed for the deferral of gains. And the rationale behind it was that if you're not cashing out, if you're going to have a continuity of investment, why should we penalize people if they're just going to continue their investment from A to B? You're in real estate parcel A, Now you're going to be in real estate parcel B. You're not taking any cash off the table. Why should we penalize you? If we did penalize you, there would be a lock-in effect where people just wouldn't sell. If you knew you were going to give away a third of your hard-earned equity if you sold your farm in Wilmer, would you sell it? I know a lot of farmers, and one thing I have come to understand about them is they do not like taxes uniformly across the board. Farmers do not like taxes. If you told them that they were going to have to give away a third of their hard-earned equity, they just wouldn't sell. They would be locked in. Now, why is this history lesson even relevant? Because the same rationale exists today for keeping 1031. It stimulates the economy. It prevents the lock-in effect. It increases velocity in the marketplace. There are other code sections that encourage investment in real estate. For example, the Section 121 principal residence exclusion allows people to exclude $250 if they're single, $500,000 of gain profit on the sale of their domicile, without which there's a lot of people at KW residential real estate that wouldn't be selling as many homes. And we want to have people getting in and out of those homes quickly. Why is that? We want to have velocity in the marketplace. When there is velocity in the marketplace, there's a strange interconnection between real estate values and unemployment. And I believe it's because when people change real estate and acquire a new asset, they tend to spend money on it. They go to Lowe's, they go to Home Depot, they reinvest, they re-envision, they repurpose, and utilize that property to a higher and better purpose, rather than the status quo. All right, so this is the rationale for 1031. Now, I am going to make a non-political observation. In the Democratic platform for the Democrats' convention, on page 15, they have laid out the elimination of Section 1031. And they have also laid out the elimination of the step-up in basis. And for a number of years, there have been anti-1031 proposals in budgets and so forth from one party. So that's going on the Democrat side. On the Republican side, in 2018, the Republicans sacrificed a great chunk of Section 1031 in order to get immediate expensing. They sacrificed it on the altar for their own purposes. So either party, the Republicans or the Democrats, could potentially do away with this little code section. On the one hand, it's maybe seen as a fat cat loophole that's abused by the richy rich people. And on the other hand, it's kind of viewed as an ancient ancestral inefficient mechanism that was used 100 years ago but could be streamlined today. And so we need to be vigilant and participate and let our Congress people know, hey, you do away with 1031, we're not going to be selling any farms in southern Minnesota. They're just not going to sell. We're not going to have much velocity. It's going to be like a tumbleweed blowing through Worthington, Minnesota. Just nothing happening. All right. Disclaimer time. I am a licensed attorney, and I can practice law in the state of Minnesota if I choose to. But I'm not going to be entering into an attorney-client relationship with any of you. This is all for pedagogical, educational purposes, and everybody should seek the advice of their own accountant, their own tax attorney that knows their own specific situation. In order to really give legal advice, you got to know the client's situation and apply the law to their specific facts. And I'm going to say, I don't know any of your facts and I can't apply it to them. So please just take this for what it is, pure education. There's no CE credits for attorneys. There is credit, though, for real estate agents. 26 U.S.C., United States Code, Section 1031A, says that there's basically two parts of this litmus test if you want to defer your gains. First, the exchange has to be of real property. And that real property has to have been held for a qualified purpose. The qualified purpose is held for investment or for use in one's trade or business. That is the strike zone. Both the relinquished property that's given up, as well as the replacement property that's received, has to be held for this qualified purpose. I was on a video call with a husband. We're discussing the qualified use requirement. They were selling raw farmland. They wanted to buy a condominium, but the condominium association rules only allowed 4 months of rental. It was really restrictive. And I couldn't see his spouse off camera, but I was certain that she had designs that when it wasn't being rented for the 4 months, she wanted to be using that property for personal use. And I said, look, there's a case called Moore v. Commissioner, where the IRS challenged a lake cabin to lake cabin exchange where there was no rental, no investment intent. It was all jet skiing, barbecuing, and personal use. And the IRS said in that case that your personal use is absolutely antithetical to holding for investment in one's trade or business. By the time we were done with that video call, they decided not to do an exchange. It wasn't for them because they weren't willing to jump through the hoops and hold it for productive use in a trade or business. Even though I told them the IRS, under the own IRS safe harbor, only tests the first 2 12-month periods after they receive it. And after 24 months, they can pretty much do whatever they want. They were impatient. They wanted immediate gratification. So maybe one of the principles here is in order to do these exchanges, you kind of have to defer your immediate gratification. You have to reinvest all of your equity into the replacement property. You have to continue your investment. If you have mortgages on your relinquished property, you may have to go out and get back on the debt treadmill with our friends at U.S. Bank, hopefully, in order to satisfy all of the benchmarks for a valid 1031. Generally, you got to go up or equal in value. You got to reinvest all that radioactive equity, cash, and you have to offset your debt relief by either taking out new debt or by adding more cash in out of your pocket. If you win the Powerball lottery on the way to your replacement closing, you can just write a check and say, I don't need to take out a mortgage. I'll offset the debt relief out of my own pocket. That's fine. You can do that. Well, here's the old scallywag himself, TJ Starker. Some people that sell insurance slip into the vernacular of talking about 1035 exchanges, which is the swapping, simultaneous swapping of insurance products. Anyone sell insurance? Anyone know what a 1035 is? Well, the 1031 provision back in the olden days was very much like the 1035 provision. It was thought that it had to be simultaneous, concurrent, like the old-fashioned horse swaps. I'll trade you my farm, you trade me your farm, we'll do a simultaneous trade. TJ was a wild, creative, non-conforming type of person. And he said, I'm a lumber baron in Oregon, and somebody wants to buy all my lumber holdings, but I don't have any replacements that I want at this time. So I'll make a deal with the purchaser. I'll convey my lumber holdings to the purchaser in exchange for the purchaser giving me replacement properties that I'll designate in the years to come. He basically concocted the first non-simultaneous exchange. Sell on day 0, receive replacement property sometime in the future. non-simultaneous. Well, this blew the IRS's mind. They went all the way to the United States Supreme Court. And then for the litigators in the room, TJ won on a procedural argument. It was an estoppel argument, but he won nonetheless. And so his name, Starker, has been intertwined with 1031. A lot of people call these Starker exchanges because of old TJ Starker, who won the first non-simultaneous case and opened the floodgates for an entire industry of people that facilitate exchanges. In 84 and in 91, Congress gave the Internal Revenue Service and Treasury the authority to write their own Treasury regulations. And in doing so, they implemented these requirements for the guardrails that kind of keep 1031 on track. They imposed the 45-day identification requirement that you have to designate your replacement property within 45 days after the date of the sale of the relinquished property. You have to clearly and unambiguously describe your property. And you have to receive the replacement property by the 180th day. Recently, I was asked by a Tennessee attorney to act as an expert witness in a case involving litigation between a home builder and a taxpayer that was doing the exchange as the purchaser. The taxpayer was frustrated with the home builder when the home builder did not complete the home and receive a certificate of occupancy and did not deliver the replacement property to the purchaser within their 180-day time frame. And I was being asked to act as an expert witness for the home builder's attorney. And they sent me some information about the case, and I checked with my partners, and they're like, Jeff, we don't want you to do it. You represent taxpayers doing exchanges. This is contrary to our client's base. This is absolutely antithetical to who we work for, which is the taxpayers doing the exchange. We want you to bow out gracefully and just decline this expert witness gig. And so I did. Gave the case to a different attorney that I know in downtown Minneapolis, who has previously done that kind of work. In the year 2000, it was a watershed year. We knew how to do forward exchanges because we had the regs from 84, 91. We knew about what a qualified intermediary was. We knew how to sell the relinquished property first. We knew how to receive the replacement property last within that 180-day time frame. But prior to 2000, we didn't have any guidance on reverse exchanges. What's a reverse exchange? That's typically when the replacement property is acquired first, before the relinquished property is disposed of. Now, there's two ways to do a reverse exchange. You can have the intermediary, who is not your agent according to the regulations. You can have your intermediary acquire the replacement property and act as your surrogate, your straw man, substitute purchaser, and acquire the replacement property and hold it for up to 180 days. Sometimes when you go to a banker and you say, hey, banker, we want to completely change the loan. The borrower is now going to be an exchange accommodation title holder wholly owned by the intermediary because the buyer of our relinquished property backed out. Now we got to do a reverse. Surprise. And the banker's like, hey, I just barely got your loan approved by the loan committee as it was when it was a normal deal. Now you want to throw this crazy curveball at us and see if we can get this deal done still? Isn't there some other way to do a reverse exchange that doesn't require me to completely upset the lender and the loan that's already approved? Well, that's called a front leg reverse exchange. In a front leg reverse exchange, we have you convey your unsold relinquished property to the qualified intermediary. We liberate you and free you from that relinquished property so that you can move forward and acquire the replacement property as you ordinarily would. A front leg works well when your client's got cash, enough cash to loan to the intermediary's entity the equity that would ultimately be derived from that sale, so that amount can be paid to the intermediary and then used and applied as the downstroke for the replacement. Right now, we've got some complicated front legs going on where clients maybe sold 3 or 4 ordinary relinquished properties, but had a few stragglers that they haven't yet offloaded. So we're using the front legs as a means to get them synthetically sold to the intermediary. In either case, you got 180 days to wrap up the reverse exchange. You got to get that relinquished property off your books and really legitimately sold to an unrelated third party, a real purchaser, if you will, within 180 days. It's a Band-Aid. It's a way to get the deal done without jeopardizing the tax deferral. It's more complicated, it's more expensive, but sometimes it's necessary. In 2004, the IRS augmented 2037. They changed it with a subsequent Rev Proc. They said, hey, you cannot take Title II and park a piece of real estate that's been owned by the exchanger within the last 180 days. They didn't want us parking properties that were already owned by the taxpayer. There were some cases in the 1033 context, and there were some in 1031 called Bloomington Coca-Cola. They generally didn't like the idea of people using the expansive power of Rev Proc 2037 to construct improvements on land already owned by the taxpayer. And so we kind of thought, well, I guess you're swimming upstream if you want to construct improvements on land that you already own. I guess you can't do that. And then, strangest thing happened. There's a private letter ruling issued in like 2008 where the taxpayer had inadvertently purchased the replacement property first, buying it through a disregarded single member LLC. But basically they put their foot in the bucket and they bought their replacement land that they were going to do the improvements on first. And they said to the IRS, hey, is there any way we can like rectify this by, instead of constructing the improvements on the fee title that we already own, what if we curate the facts so that there's a long-term ground lease of at least 30 years or more on that parcel, and the lessee or tenant on that ground lease is the exchange accommodation title holder, the intermediary, so that the intermediary owns the ground lease and the intermediary constructs the improvements on top of that ground lease. And what the taxpayer or exchanger really receives is that ground lease plus the improvements that have been constructed. And in that private letter ruling, the IRS said it was okay. But that is the most scant of legal authorities, because a private letter ruling isn't really authoritative to anyone except for the taxpayer that sought it out. But they haven't revoked that private letter ruling. It's still out there on the IRS's website. And maybe it's indicative of what their current thinking is, what's permissible. So a lot of taxpayers have been using that private letter ruling as a blueprint to construct improvements on raw land underutilized land that they already had. In downtown Minneapolis, there was a beautiful architectural building that had a flat surface parking lot behind it. It was kind of a novelty for downtown Minneapolis to have a flat surface parking lot, completely underutilized. The taxpayer that owned that sold a relinquished property in St. Paul. It was an apartment building, needed a place to put the money, couldn't find any existing property, so they utilized this lease and constructed on top of that leasehold 11-story micro apartments that now exist there and have created workforce housing for people living in downtown Minneapolis. So it's a win for everybody, I think. As far as I know, that was never challenged. It went through swimmingly. Everything's fine. In the year 2002, there were a lot of people doing syndications of real estate. People figured out there's a lot of mom and pops looking for a place to land with their 1031 monies. And they don't want more toilets and tenants and trouble. They don't want more management. And so syndicators were buying these triple net leased Walgreens, Arby's, CVS's, and they were slicing them up into fractional tenant and common interest and selling the tenant and common interests to investors that needed a place to land with their money. And that was very popular until the big Great Recession that happened in like 2008 to 2012-ish, because that tenant and common model was stressed heavily by the ravages of that tough recession. Many of those TIC deals didn't work out because in a tenancy in common, everybody gets a vote that's a tenant in common owner. And in order to make certain decisions, it has to have unanimous 100% agreement. Should we refinance? We need 100% agreement. Should we release it at a lower rate? We need 100% agreement. Should we just sell the property and get out? 100% agreement. These tenant and common syndications were assemblages of purchasers from all over the country that didn't know each other. They were just captive in the same investment. As you can probably imagine, that didn't work out for some of these investors, and the whole tenant and common model has kind of fallen into the back seat as a way to syndicate real estate. Unless it's a couple of buddies or family members or an informal small group of people that trust each other, you don't see tenant and common syndications that often anymore. Today, the model that most syndications take is a Delaware statutory trust. Let's say that Scott purchases an Amazon distribution center and puts it into a Delaware statutory trust. It's all stabilized. It's fully leased, it's fully occupied, financed already, it's stable and steady. And now you're going to sell the beneficial interests in that trust to investors that need a place to land. You are now selling securities probably, and probably one of the barriers to this model is you have to be a licensed securities rep to sell these, and you probably need to have your offering approved under the securities regs. But let's say that Scott starts doling out percentages of that Amazon distribution center that's owned inside of the Delaware statutory trust. There's only one mortgagor. That's the trustee of the trust. Not like 35 co-investors in the old TIC model. And it's just easier to run because there's just one figurehead at the top of the pyramid, that's the trustee. All of the beneficial owners are just passive participants. And so that model has become a really popular model. Firms like Morgan Stanley, Merrill Lynch, Ameriprise, RBC Wealth Management, US Bank Wealth Management have products that are sold and regulated as securities, and they qualify for 1031. And then there's the even more novel investment, which is what Joe Wong from Dallas, Texas is selling, which is the oil and gas royalty program. So there are interests that qualify for 1031 that maybe on their face you would say that does not look like a like-kind investment to me. But they are considered like-kind if they're set up correctly. As I said, in 2018, the Republicans sacrificed a great segment of the 1031 treatment. We used to be able to do exchanges of airplanes, railroad cars, printing presses, business equipment, farm equipment. All the non-real estate was eliminated in 2018. Rental car companies used to do exchanges on their fleets when they turn over their 1985 Pontiac Topazes to get Ford Fiestas or whatever. They would do series of personal property exchanges. That all was eliminated in 2018. And so it's possible with just a stroke of a pen that the code section could be either eliminated or radically modified. There are groups like the Federation of Exchange Accommodators, which is a trade association for intermediaries, or the Real Estate Roundtable, which is a group of like-minded real estate professions that work together to try to educate Congress, because there's always turnover. As staff members and as legislators, there's always turnover. We need to educate them about the benefits of keeping 1031 and other real estate incentives in the tax code to keep the economy working correctly, to keep U.S. real estate values high. All right, that concludes our introduction. I do want to encourage questions, so if you have any, this is a good time to ask. Yes, sir.
You just brought up the industries that are in favor of this system and these laws. Why does it feel like it's being attacked, and who are the attackers? Is it just the Democratic Party, or is it?
I don't think it's just the Democratic Party. I think it's a fraction, a small 20% of the Democratic Party, because most moderate Democrats represent farmers. And farmers have a great deal to lose if the step up in basis, if the 1031 goes away, right? These family farms won't be able to stay in the family. They'll be sold, basically. So I think it's a small segment of the Democrat Party that's most vocal and perhaps most influential. Now, I say that as an apolitical, and I'll just tell you right now, registered Democrat, moderate Democrat, caucus in downtown Minneapolis as a Democrat. So I'm not against Democrats at all. But what I will tell you is I think that we need to make careful, judicious decisions, because they can have awful effects on real estate. In 1986, Congress played with the depreciation schedules on how quickly you could write off or depreciate real estate. It was part of an overall plan to streamline the code. And it put real estate in the dumper for about a decade. Values declined, real estate didn't trade, and it probably was the precipitating fact that caused the savings and loan industry to blow up and completely fail. It was a rippling consequence of that. So there can be really adverse effects if you change the tax code. The tax code is like the owner's manual to a Lamborghini. If you turn this nugget or this screw a little bit, it maybe increases the richness of the blend on the fuel a little bit, makes the engine rev a little faster or a little slower. You gotta be careful how far you turn that screw. Good question. Any other thoughts or questions? Yes, ma'am.
Hang on, Jeff.
Yep.
They can't hear us online, so. No, the questions I can't hear, so you.
Oh,
Yeah.
I will
You're-
repeat the
You're
questions.
good.
All right, sorry about that.
In the honor of Phil Donahue, I'll be passed, rest in peace. Most people don't know who he is. Do you? Yeah. figured it out.
I just want a clarity on the exchanges, right? So let's say you've done a bunch of exchanges and you decide to sell. Are you responsible for all the previous or just that one that you want to sell?
I think that the question has to do with when you've exchanged and deferred your gains in the past into a particular property. And that property now has gone up in value. Now you want to sell it. Do you just have to pay the gain on the current appreciation, or do you have to pay the gains on all of the predecessor exchanges that occurred before that? And the answer is you pay the piper on the whole thing. Because unlike the principal residence exclusion that excludes from the computation of gross income the profits from sale of a principal residence, unlike that, in a 1031, you're merely deferring the gain. Imagine I'm picking up a Samsonite suitcase full of deferred gain. I'm carrying that gain with me to the next property. And what I might end up doing is to continue to parlay and defer and defer and defer throughout my lifetime. Always deferring the gain, never unnecessarily recognizing the gain. That means I've got more equity to redeploy into my replacement properties. That means that my lender will probably qualify me for buying bigger and bigger investments as I prove up my chops as a competent steward of the real estate. So using OPM, using my experience and using my accumulation of equity, I can probably accumulate quite a bit of real estate during my lifetime. Sadly, what's going to happen at the end of my run?
One more question, or another question.
So the end of your run is your death. So what happens to those deferred gains at the time of your death?
Well, unless Congress does something to change it in the years to come, Section 1014 says that when you die and your heirs inherit the property, which in this case would be the real estate, they don't take mom and dad's low basis that they carried during their lifetime. They take not the decedent's basis, but the fair market value of the property at the time of the decedent's death. And I'm paraphrasing and simplifying just to make it a little bit easier to understand. But generally speaking, the basis is stepped up to the fair market value. So let's say that you die owning 500 units of apartments free and clear. And your children have just been read the will moments before your funeral. They're at the funeral, the casket's there. Children are crying. Dad's body is lying there. And you have to wonder, are those tears of sadness? Or if they just realize that they can sell the apartment building with almost no tax moments after your funeral, right?
Okay, Jeff. You gonna keep going on that one?
No, we'll take more questions.
Wait, more questions. I think I'm gonna save you here.
Just wanted to know what kind of RBC wealth management or US wealth management products qualify for 1031 exchange?
Each financial institution, whether it's RBC Wealth Management, US Bank, Merrill Lynch, Morgan Stanley, or Ameriprise, they decide what products can be put onto their platform. They do their own due diligence on the properties and the sponsors. And they restrict their financial representatives to only selling those products that are approved by the House. Okay, so perhaps Morgan Stanley has 4 DSTs that have been approved. JLL, Jones Lang LaSalle. They might have the old Black Creek, now owned by Ares. They might have a Heinz product. They might have another one. I think Starwood's going to get into the game. I don't know that they're approved by anyone, but there's a lot of sponsors. I just named some of the big ones. A financial representative for a particular institution can introduce to their clients those products that are approved by their broker-dealer, their platform. And so you'd have to talk to the alternatives desk at RBC or at US Bank Wealth Management, say what DSTs are applied And who's the wholesaler that's assigned to our organization? Because I'd like to set up a call with me, my client, and the wholesaler for that product to get more specifics about that particular product. And that's how you get the insights on that.
All right, another one over here.
Thank you. Post 2018, where the limited exchanges went away, what have like the rental car companies done? We as consumers has that gain been passed on to us? And what else have you seen in the industry with other exchanges that are no longer acceptable?
Initially, the car companies didn't care because they got immediate expensing. They were able to take an immediate tax deduction and write off that brand new Pontiac or Ford Fiesta. But the expensing is ratcheted to decrease. First, it was 100%, then I think it went down to 80% and then 60% and so on. I don't know where we're at now, but eventually they won't be able to take those advantageous super fast write-offs. And they're going to wish they were under the old paradigm again so they could continue to trade in the old vehicles and get tax deferral. But they were kind of enticed by the sugary sweetness of immediate expensing, but the immediate expensing is fleeting, and that's the problem for them. They probably will regret the decision that they didn't lean on the legislators to keep it in the code. They didn't voice up their opinions very loudly, and they lost personal property exchanges as a result of it.
You got one over here. Oh, here we go. Oh, you need the mic.
Thank you. It was back a long time ago, but in 2001, I purchased a property for a little over 200,000. I had it for until 2023 and sold it for 585. I had to pay state and federal tax of a little over $200,000. So you're 100% right. Save it until your kids can transfer it over, and there's no tax on it at all.
That was an important lesson that you learned. And the tuition that you paid was about $200,000, probably similar to the Cornell undergraduate tuition that some of us might have paid.
Well, over the years, I have used US Bank and also Bell Mortgage. Gary Kurt was the owner, the old-time owner at the time. And I was lucky enough in 2003 to work with him, and I had a $7.7 million month. And I tell you, there's a lot to go with it here. So, but I got another, let's see, I started in October of 77. So hopefully I'll make 50 years in the business and then get a chance to retire.
I want to ask you a question, sir. For the young investors that are in the room that maybe are just starting with a single family rental and want to someday parlay it up into a duplex, and then maybe through 1031s continue to parlay to a fourplex, an 8-unit, a 16-unit. Over the course of their lifetime, over the course of 50 years, do you think it's conceivable that the average newbie in this room could someday own 100 doors?
Absolutely. I started in purchasing rental properties in 84, had 17 of them. I'm down to 9 now. And I put everything in a trust, AB trust. And the attorney that I was working with had me all fixed up for that. So like you were saying, the long-term with a trust is, I think, far better than anything else that you can do. And I was the business brokerage chairperson in 1984. And in 1983, I was lucky enough to be the top producer in the 5-state area and number 37 in the United States for Realty World Corporation.
Were you a real estate professional?
Well, yeah, I would hope so.
Okay. All right, I'm
I was
going to
with
have you.
Calhoun Realty, I started.
I'm going to have you hand the microphone back to Matt. Well, I just want to make just one comment.
You want to keep going, Jeff?
Some real estate professionals. Now, if you're an attorney and you do real estate closings, you may be in the real estate world, but you may not be considered a real estate professional. If you're a real estate agent, property manager, you might be considered a real estate professional. If you devote a certain amount of your time to your real estate holdings, you may be considered a real estate professional. Why is that important to understand? Because when you are a legit real estate professional, you don't have any caps on how much you can take for depreciation deductions against your earned income that you make on, say, commissions as a real estate professional. Some real estate professionals have so many apartment building holdings and real estate things that they manage that the write-offs from the theoretical decline and wear and tear on those properties, those non-cash theoretical losses are used to basically wipe out their income tax liability. I see some people, Monej, is that correct? Yeah. So if anyone wants to audit him, he lives in the western suburbs, I believe in Plymouth.
Someone Google 1984 top brokers.
Hopefully a real quick one. So you mentioned farmers having a 1031, doing a 1031 exchange. Total curiosity. What is a farmer exchanging into? Are they buying the dollar stores? Are they going to Starbucks, or what's a typical farmer play?
My wife grew up in Jackson, Minnesota, which is out by Worthington, Stoughton, Jeffers area. And those farmers, they love to work with me and my wife because we're in downtown Minneapolis. We don't go to the local coffee shop. We don't shop at the local general store. Nobody knows us in that town, and we keep our mouths shut. They buy whatever they want, but they're really secretive about what it is they're getting. Particularly in the western Minnesota, northern Iowa area, that is some of the best farmland in the world. Most productive, maybe Ukraine, and then like northern Iowa, western Wisconsin. Those farmers know that if the word gets out that they've got a bucket full of 1031 monies sitting with an intermediary, the other sellers in that community will know they got them over a barrel. So they're very secretive. They want to buy more farmland. Farmers generally want to buy more farmland, and they want to buy closer in to their home farm. They don't want to be farming land on the other side of the county because it takes gas and wear and tear on their equipment to get it over there. There's synergistic reasons. And farmers typically want to buy really productive land. So those are their primary motivations. Like, what is the soil like and how close is it to my home farm? Now, there are some farmers, their kids all went to South Dakota State University. They competed at Division I level for rodeo. And then their kids got degrees in accounting and now work at U.S. Bank, and they're not coming back to the farm. Because farming is a lot harder than working at U.S. Bank. So there are some farmers that say, look, my kids don't want it. It's been in my family for 4 generations, but I'm going to sell it because I don't want my children to have the emotional toll of having to, make this decision. I'm going to take it on the chin for them so they don't have that emotional toll. Also, they wanted to be able to divide the asset amongst maybe 4 or 5 kids. So what do farmers buy in that situation? I would say that they're probably going to the RBC Wealth Management, the U.S. Bank Wealth Management, the Morgan Stanleys, the Merrill Lynches, and they're buying these securities because that farmer then can have a better, more reliable stream of income for the remainder of the farmer's life. But a lot of those Delaware statutory trust investments are designed to do a 721 conversion up into the heavens of a REIT, an UPREIT, and those UPREIT shares are then completely divisible and liquid. So after the death, they can just easily be divided. Bobby takes 400 REIT shares, Susie takes 400 REIT shares. If they want to continue to receive that passive income, great, hold it. If not, there's a market for those and a strike price typically picked. So a lot of people are using the DST conversion to an UPREIT to set the stage for their eventual disentanglement and distribution to the heirs.
Jeff, you're scaring me a little. My leader in South Dakota grew up on a farm, went to South Dakota State, got an accounting degree, and now his parents don't do with the farm. So, I don't know. And you've never met him, right?
I've never met him.
That's freaking me out. So, all right.
Wow.
Let me another question here.
Jeff, when there's been a major change or limitation to this in the past, historically, what's been the time period from when there was an announcement made to when it went into effect? Meaning, if it does go away or there's another major limitation going, is there going to be a period of time where there's a flurry of activity, or is it going to effect immediately?
Many people think that there's going to be some huge tax legislation in 2025 because many of the current tax policies are sunsetting and ending in 2025. And both sides are going to want to do something. We just don't know what the election's going to say and who's going to be in a position of power to push their agenda. But usually when things happen, it happens fast. Sometimes, unfortunately, they say, well, read the legislation after we sign it. They don't even know what's in it exactly. They're not reading the fine print. And that's where I'm afraid that if we're not vocal in the real estate profession, if we're not influential in speaking to our legislators about preserving 1031, some of us may not be making much money after 2025. Some of us may just be retired. Question over here. I thought I saw a hand. Yes, sir.
Last one. So then let's pause him, Jeff. How does that sound? Don't you have a robust presentation after this, or is this? Or do you want the questions? I just want to sit down.
You can do whatever you want.
Is that all right?
In the 1031 exchange, the 45-day identification and the 180-day exchange, is that absolute, or is there some cases work around that?
Those are pretty hard and fast rules. The 45-day and 180-day rules are hard and fast. However, have you guys noticed that we've had a lot of presidentially declared disasters with the forest fires, the hurricanes, the earthquakes, and calamities that are happening? Every time there's a federal disaster, there's usually an extension allowed for those folks that are adversely affected by that event. For example, if your title company that you're supposed to close your replacement property on is under 2 feet of water, and their equipment systems, photocopiers, none of it works, all of their paper files are mush, it's hard to get a closing done. So you're probably entitled to an extension. We have had people that have tried to buy properties in Florida and have had to avail themselves of extensions that were permissible because of the hurricanes and so forth lately. It's very sad, but that's the case. Otherwise, if you're just a run-of-the-mill 1031 person, there really aren't any extensions. And I would say that these rules were not designed with your success in mind. These were designed to limit the number of people completing exchanges. I want to tell you about a trap for the unwary. We've said that the exchange period is 180 days, but we're late in the year now. And if you were to sell your relinquished property, say on December 26th, your 180th day would be sometime in mid-2025. And the IRS doesn't want to wait another tax year to find out how this story unfolds. So they say, your exchange period is capped at the due date for the filing of your federal income tax return. So if your 180th day falls after April 15th, you're shortened down to the federal filing deadline of April 15th. Now, there's an easy way to fix that. What is it? Tell your accountant or tax preparer, we need to do an automatic extension and extend our April 15th deadline to say October 15th. But sometimes the right hand and the left hand don't know what we're doing. And the accountant blissfully and ignorantly just dutifully files that tax return right on April 15th. So, Scott, do you think it would be prudent for a real estate broker, a real estate professional to send an email around to the client and include the accountant and say, just want to make sure everyone knows we've sold a relinquished property in a 1031. It may be necessary to file an extension. Maybe, try to encourage the dialogue with the accountant early, because I have had accountants call me and say, we didn't know. And I show them the letter that I sent to their client that says, here's your 45-day, here's your 180-day, and here it appears that you might need to file for an extension if you need to get the full breadth of your 180 days.
Does that apply to all tax returns or just for
It applies to businesses as well. Now, businesses may be filing on March 15th, so this might be even doubly true for businesses because their deadline for partnerships, for example, are March 15th. So yeah, it applies to everybody. The due date for the federal income tax return for the entity that's doing the exchange. Thank you for the question. When I facilitate 1031 exchanges, I usually operate under one of the modalities that's called the qualified intermediary safe harbor, where we act as a third-party administrator to facilitate exchanges. But that's not the only safe harbor that they allowed. They also allowed a qualified escrow agent. And what I like to do is belt and suspenders. I have the monies held by a bank acting as a fiduciary under a qualified escrow deposit agreement, wherein the bank plays the role of the qualified escrow agent. Their job is to hold the money, safeguard it, and not release it without the client's written authorization. So if you don't sign the disbursement request to send the money to the replacement closing, money doesn't leave the bank. That way you can sleep at night. Oh my gosh. I go to the closing, my money, my $500,000, my life savings gets wired off into the ether. How do I know I'm protected? Well, I know I'm protected if I've got a reputable bank holding the money pursuant to a qualified escrow deposit agreement, and they're not allowed to release the funds without your say-so. Now you say, Jeff, I still don't trust you. It's all my life savings. What are we going to do? In certain instances, I will introduce you to the banker at the bank that's going to hold the money. And I will say to you, you guys work out a secret password. It's only known to you and to the bank. And we'll write up a rider to our qualified escrow deposit agreement that says the bank not only has to check for your signature, but then has to do a verbal callback and call you at a designated phone number to verify the wiring instructions are correct. They'll go through it with you, A, B, and C. And then if you don't say the secret password, they don't release the money. Aardvark 75. Okay, we'll release the funds. So we can set up protocols to protect and safeguard the client's monies. Now, why is that important? Back in 1999, there was a guy running around like I am today, doing presentations, teaching people about 1031 exchanges, probably even getting CE credit. His name was Jack Davies. Allegedly, he took the monies that were entrusted to him and invested them in internet stocks. What happened to the tech market in around 1999? So he lost a bunch of people's money that was entrusted and he was supposed to hold. But did he tell the clients? No. Instead, he continued to take in new money from new clients and used the new money to satisfy the obligations for the old clients for whom he'd lost money. He tried to keep it up as long as he could. It became what's called a Ponzi scheme. And Jack went to federal prison. In 2008, there was a Fortune 500 company. It was the amalgamation of lawyer's title and Commonwealth land title, and I think transnation title. They all merged together and became Land America. And they had a subsidiary called Land America Exchange Company that was receiving in funds. I worked at Land America Exchange Company, not when this happened, but beforehand. I worked there. They took the money that was entrusted with them, instead of segregating in separate bank accounts and holding it, they commingled it. And they used it to buy securities that were backed by student loans, because they thought student loans, you can't get out of those. They'll never become illiquid. But in 2008, the financial crisis was so bad that even those securities became illiquid. And when people called up their 1031 professional at this big Fortune 500 Land America Exchange Company, there was a bankruptcy trustee on the other end of the line. All of the assets of Land America pretty much were bought out by their major competitor, which is Fidelity National Title that owns Chicago Title. Land America ain't no more. They've just been absorbed into the bigger, more successful competitor. Anyone that wants to Google Land America 1031 exchange debacle, that's a good one. For the litigators in the room, imagine that you represent one of the sellers that entrusted their money with that intermediary, and you're trying to tell the judge, no, our client's money wasn't commingled with everyone else's money. Our client's money was segregated. We should get our money back. We had the wherewithal to insist upon a separate segregated bank account. Please give us our money back, bankruptcy trustee. Meanwhile, the trustee's like, oh, no, you're blended with everybody else. We're not going to give you back your money. You got to cough up, take your losses, take your lumps with everyone else. There's some very interesting cases, litigation cases that came out of California. So the moral of the story is there are models for administrating exchanges. And there are a slew of stories. You watch American Greed, the television show, there's actually an episode about a qualified intermediary. There are a string of QIs that have gone and absconded with monies, lost monies, some of whom just open up again under a different name, keep doing business. The moral of the story is buyer beware. Do your due diligence before you entrust all of this money with this intermediary. I just had someone go through a laundry list of questions like, how long have you been in business? Do you have a fidelity bond? Do you have errors and omissions? Are you licensed to practice? How many Google reviews do you have? Are you Better Business Bureau listed and approved? Just a ton of questions. I'm like, yeah, I'll send it to you. We're all good. Been doing a business since 1998. But they were like checking me out thoroughly. And then I found out why. The proceeds are going to be over $200 million. And they were like doing their due diligence, making sure that they weren't using a disreputable intermediary. All right, here is our linear timeline of a standard 1031 exchange. Is the real estate market hot, or is it hot? Or is it not hot? What do you think, Scott?
Good question. It's mediocre.
I would say for the people that I'm doing exchanges for, they can't seem to find their replacement properties. There's a problem with inventory being thin. And if you want something good, you're competing against a lot of people for it.
Interest rates are too high. You gotta wait for them to come down.
Perhaps, or perhaps it's the opposite.
It doesn't cover
That's because the sellers haven't taken their mental change yet, right? But let's not get into that argument. Let's talk about the fact that 45 days is a very short period of time in the timeline of buying replacement property. Oftentimes you got to negotiate a deal. You got to get a phase 1 environmental. You got to get a survey. You got to get an inspection. You might have to read leases. There's a whole myriad of due diligence things you got to do. You only got 45 days to pencil out and designate what replacement properties you might want to receive. So the smart real estate investors probably are trying to get that sure thing lined up even before they've sold the relinquished property. Like a martial arts expert, they're able to split their energies into two sides. You know, I can do something over here, but I can also do something here. I can list my relinquished property and I can tie up my replacement at the same time. Because that's a short period of time. For real estate professionals that like to get commissions, cha-ching, cha-ching, you probably not only want to get the listing, but you probably want to get the purchase. And so you want to work with your client to say, look, let's be successful. Let's get an option agreement. Let's get our hooks into a piece of property. Let's put the handcuffs on the seller. Let's make sure that we don't sell the relinquished property and play musical chairs and have nothing to land on or nothing good to land on. I was at a dinner last night with Joe Wong and another financial professional. And the other professional had a great idea. He's like, well, what if my client can't find the property they really want? Could they go into the oil and gas thing for a year or two? And then could they sell the oil and gas thing? And Joe said, not only do we sell the investments, but then we'll also, for a 4% commission, find a buyer to take you out of the investment. We constantly have people wanting to get into these deals. And so the financial professional was like, wow, that's a game changer. I could buy that investment as a temporary sort of play for a year to two. And then when the market changes, I want to come back into traditional bricks and mortar, I could come back in. So I thought that was an interesting, I watched the wheels turn as the problems were solved in that person's mind. The other reason that timeline is so important is if you can't find a patient seller that will let you put the hooks into them, put the handcuffs on, then do a reverse exchange. Get a sure thing lined up and have it parked with the intermediary. Because right now, I would say selling is probably still easier than finding and acquiring. So lock up the sure thing. We have clients that are selling property in South Dakota, and they're buying replacement property in Green Bay, Wisconsin. The buying is the easy part for them. So we're going to park that Green Bay, Wisconsin property in an intermediary entity, and then they're going to take up to 180 days to get their South Dakota property sold. But they didn't want this not to turn out to be a 1031. It has to be a 1031 for their business model to work. Here's the note about the due date, shortening up that exchange period. It's the 180 days or the due date, including extensions of the transferor's tax return. You can revoke your identification. Let's say that you sent in an identification on day 30 to the intermediary, and then you had a change of heart. Like, I don't want to buy that property anymore. I'm going to buy something different. You can revoke it. If you do so, you have to re-identify in writing. It has to be signed by the taxpayer, and it has to be sent back into the same party that you originally identified to. You have to identify to somebody that is a party to the transaction who's not a disqualified person. You can't identify to your mother, your brother, your business partner, your employee. Typically, you're identifying to people that are unbeholden to you. And more importantly, if you're not only identifying the location of the asset, but also doing what's called a real property improvement exchange or construction exchange, you must identify the improvements that don't yet exist. Let's say that you sold a property for $500,000 and the land is only $100,000. In order to have a fully tax-deferred exchange, you need to continue into a property worth 500 or more. So you'll have the intermediary purchase the property for 100K, and during the remainder of your 180-day exchange period, you'll arrange for the construction of 400,000 or more of improvements, so that when you do receive the property, it exists as real estate worth at least 500,000. So there's a continuity of investment into equivalent or greater valued property. But you have to describe those improvements. And you have to receive substantially the same property that you identified. Matt, if you're around, there is a question way in the back there. We're going to make you work a little harder today. He has to walk all the way from the 651 area code to the 763.
I live with the 763. Wow. You can start maybe. Yeah, you try with me.
So like in a case like that, is it all or nothing? Like if you don't get that completed in that time, do you only get to defer that 100?
That is a great question. 1031 exchanges are not a zero-sum game. You can have a partial deferral and you can have a partial recognition of gain if you buy down in value. I want to explain it to you two different ways, from the bottom up and then from the top down. From the bottom up, let's say that when you sold that $500,000 property, that your remaining adjusted basis is $200,000. Maybe you bought it for more than $200,000, but because of depreciation deductions that have whittled down your original cost basis, you've now only got $200,000 of basis. When she acquires her replacement property, her old basis, like Samsonite luggage, gets transferred to the new property. Her original $200,000 basis comes over here. And she only begins to really defer gain dollar for dollar to the extent that she buys up in value over and above her transferred basis. So let's say that she bought a property for $450,000. The first $200,000 of that is just a wash because her basis came over. The next $250,000 she's deferring gains on, right? But then she turns out to be short value. And dollar for dollar, to the extent that this property is of lesser value, she's going to recognize gains. So it was a partial victory. Still, she deferred gains on $250,000 and only recognized gains on $50,000, but you know, it's not the end of the world. How could she have improved her outcome? She could have bought more. She could have identified a second property. We just had a man buy a corrugated steel building. It's basically a storage condo where construction equipment can be kept. And it costs about $50,000. So you could buy a $50,000 investment and tack it on, cobble together two investments so that your total investment comes out to be what it is. Or you could buy a DST. You could go to our friends at RBC Wealth Management or US Bank Wealth Management, and you could buy a small DST. If there's minimums that are small enough to allow you to do that, theoretically there would be. Or you could do a construction exchange. You could enhance the value of the replacement property by arranging for $50,000 of construction to occur and exist as real estate. Are 2x4s laying on the ground real estate? Are windows on a pallet on a truck in the middle of Ohio real estate? You need to make sure, if you're doing a construction exchange, that those 2x4s get erected, incorporated into the building, that those windows are installed and exist as real estate, that they are incorporated permanently into the structure, if you want to count the value of those windows and those 2x4s. And I don't want anyone to embellish the value on a build-to-suit. That will get you some jail time. You do not want to lie about the condition of the property or embellish the value. Matt, one more question back there.
I assume that's the mirror image then. If you're gonna sell 3 in exchange for 1, does any timeline change on the 45-day period, or is it the exact same?
You know, I think it depends on how your philosophy is. If you're selling to 3 different purchasers, 3 different properties, at 3 different times, under 3 different contracts, I would argue that they're 3 separate and distinct exchanges, and that you have 3 linear timelines.
Even though you're putting it into one asset?
I mean, that's my argument. I think that there maybe is a contrary argument that the IRS would say, well, really the first relinquished property set the measure. And there is a regulation that says when there's multiple relinquished properties, the first one to sell becomes the dominant timeline. And for practical purposes, it is the dominant timeline because you're trying to roll them all into the same property. So you have to identify the same property 3 times. But I would probably set it up as 3 exchanges. I would have 3 identifications, and each would be properly submitted before the 45th day on each linear timeline. Because theoretically, you could pour the money from 1 in, 2 in, or all 3 in. We want to keep all of those options available.
And then just a quick follow-up on that 2-year deal. So are you saying that after you exchange the property, you just need to continue on with what you're using it for 2 years, and then at that point it's free game? So let me give you an example. Let's say I'm 70 and I sell all of my real estate assets and I go buy a $10 million home in Boca Raton, right?
Yep.
And I rent it to whoever for 2 years.
You rent it to an unrelated third party at market rate on a real written lease, and you collect market rate rental for 2 years.
And then I go move in there and I die, and that becomes completely tax-free to my kids.
The IRS has said in at least one ruling that holding a property for 2 years was a sufficient period of time to make it eligible for an exchange. So the opposite side of that coin would be continuing to be a holder for investment or business for 2 years is adequate. And in their safe harbor that they have for analyzing rental pool properties, they test each of the 2 12-month periods after you acquire it. So that would seem to argue that 2 years is adequate. But, you know, this is the ball, and this is what the service does. They hide it. They could give us an objective, bright line rule that says, once you've held it for 2 years, you're good to go. But you can't find that in the Treasury regulations. You have to discern it from some of these revenue procedures and some ancient IRS writings. But they're asked that. The American Bar Association has asked them to do that, and they've just declined. I thought at one time it was because they had different types of property. Like the holding period for a rental car in a Hertz fleet of rental cars might be different industry-wise than the holding of a piece of real estate. I used to think, well, maybe they don't want to have a set bright line rule because nobody keeps a rental car in their fleet for 2 years. If the industry standard is it floats out after 6 to 8 months, that's the industry standard. Whereas real estate might be a longer play. I don't know why they won't tell us bright line, but they haven't. So they create this uncertainty. And in that uncertainty, it's hard to plan. I personally would do that deal. I would live in it for myself after having satisfied 2 12-month periods. I think I personally would do that. But that's not legal advice or tax advice. That's just telling you what my litmus test would be for as an individual.
Come over. You're a nicer father than I am, Devin. I've done that. It's my kid's problem when I'm dead, right? So they can figure it out.
For construction on the 1031, do you have to have the certificate of occupancy, or if you get to draw the line on the 180th day and say everything done at that point counts?
You do not have to have a certificate of occupancy. Whatever exists as real estate exists as real estate. When I park a property, I usually form one or more single-purpose LLCs. So if I file the LLC and the exchange company owns the LLC, to transfer that property to you, assuming you're the sole taxpayer, I'm merely going to assign the membership interest in our single member disregarded LLC to you, which for tax purposes is good as deeding it. But I don't have to go to the county recorder. I don't have to show them a certificate of occupancy. I just transfer the property. Now, I would like to tell you something. We've had people come to us on day 178, and they say to us, the developer hasn't completed the construction. They don't have a certificate of occupancy. We can't record a deed, but we need to get the indicia of title transferred from the developer to the taxpayer. And we say, okay, let's use a contract for deed. We'll get whatever is constructed at this point in time, the equitable title of that will transfer to the vendee pursuant to the contract for deed. We'll get what there is to get. Even though we can't record a deed, we don't have a certificate of occupancy, the contract for deed will suffice. And many of us here in Minnesota are very familiar with installment sales and contracts for deed. But if you pitch that idea to someone in upstate New York, they look at you like are you doing something illegal? They think that that's just completely foreign, that you could convey equitable title for federal tax purposes through an instrument such as a land contract. But that's a nifty way to do it. Maybe it doesn't get you 100% tax deferral because the property is not fully erected, and there may be some money being escrowed by the seller to pay for that sod that hasn't been installed or whatever, but it may not be perfect, but it may be better than nothing. Good question. You'll notice on the screen that there's 3 different identification rules. Most of our clients, mom and pop investors, are going to stick to the 3 property rule because it's so simple and it's so easy to understand. You can identify any 3 properties without regard to their value. You could identify the IDS Center. You could identify the Fauché Tower, and you could identify the Empire State Building. It doesn't matter that they're extremely expensive properties. What matters is they're 3 or fewer properties. Some clients nevertheless want to identify more than 3 properties. This often comes up in the context of securitized real estate that's packaged in Delaware statutory trusts or DSTs. What if the DST is an amalgamation of 5 or 6 properties, like a mini little portfolio? The DST itself may exceed 3 properties right out of the gate, and you've only listed 1 DST so far. So you got to be real careful when you're purchasing DSTs to talk to the sponsor, talk to the person that's selling it to you. Are these all contiguous parcels? No, one's in Ohio and one's in the Commonwealth of Virginia. Oh, so it's 2 properties. Okay. So you need to know what you're buying, and you need to know if it constitutes 1 property or 2 properties. Sometimes people want to buy Blackacre. That's their number 1 choice. but they're not sure if that deal is going to pan out. So they want to identify a backup property. So they go to their DST salesperson, their financial planner, and say, we want to list a backup property that's going to have a long shelf life, will be available for a while, and which we could pivot to in the event that Blackacre falls apart. So we want to list a DST. Well, your backup property would be great if it didn't kick you out of the 3-property rule. Your best backup property as a DST would be a single asset property, like a, I don't know, Amazon distribution center in Ohio, rather than an assemblage of 5 or 6 properties. Because you want to stay under the easy peasy 3-property rule, and you don't want to have to worry about the valuation cap. The valuation cap is a tough one because real estate is sort of subjective. If you don't have a purchase agreement with the seller of Blackacre, how do you know how much it's worth when you're trying to discern if you're under the 200% ceiling of not more than twice the value of what you sold? And these DSTs, they have leverage. Sometimes if you put $1 into a DST, it really equates to $2 of buying power. 50 cents of equity gets you 50% of debt. So every dollar you put in is really $2 of buying power. Well, you can easily kick yourself over the 200% rule if you go into a highly leveraged DST, because the debt is included. It's not just your equity you're putting in, it's the debt that's allocable to you as part of that purchase. And last, the very seldom used 95% exception, which basically is used for big portfolio purchases. You want to buy 16 CVS drugstores. You want to buy 100 oil and gas wells in North Dakota. You can identify them all, more than 3, more than 200%, but under the 95% rule, as long as you actually receive and get 95% of that which you identified, you're still valid. If one of those wells runs dry, no biggie, as long as that one well wasn't worth more than 5% of the whole. We don't really see the 95% rule used too often. In fact, what we often do see is shrewd investors and wily real estate professionals making sure that they acquire the replacement property and they get in and out of the exchange within the 45-day period, because you are deemed to have properly identified that which you receive within the 45-day identification period. So you won't mess up the identification if you already acquired the property within the 45-day period. And oh, by the way, the quicker you get your cash redeployed, the quicker you get the yield, the cash flow coming back in again. So from a practical perspective, you don't want to leave yourself hanging out there for an endless period of time. You want to get your money redeployed so you can start getting revenue again. And you don't want that uncertainty hanging over your head. Take the win. Throw the ball in the end zone, get the touchdown, win the game. Complete the exchange, get in and out within 45 if you can. Otherwise, you got to identify, and then you got to wait and hopefully acquire within the remaining, say, 135 days left in your exchange period. Questions so far?
Hang on. I was asleep on my job, Jeff. We have a question, Jeff. Let me drink his water.
The one thing that I don't know if you've gotten into yet, and it's just that who benefits most from 1031s? I've heard it's the common folks, and that's who really would get hurt.
Well, I would say that my customer base is the mom and pops. I cater to a lot of single family rentals, a lot of farmers, and a lot of small business people that are, say, moving out of their facility in the city of Minneapolis proper and they're constructing a new facility in Anoka County. It's small people that are doing these exchanges. I am just a small fish in a small market. I was just at a conference of intermediaries, and they were talking about the size of the deals they were doing out there in San Diego and in these bigger markets, and they're talking about the average size of their exchanges being well over $1 million. And I'm like, my deals are small. It's just a common, ordinary, salt of the earth folks that are doing exchanges with me. Now, every once in a while, you'll get a business. Some of these good long-term Minnesota companies I've had the privilege of working with, some of which are like 3-generation Minnesota companies, and maybe they're moving their headquarters from the northern suburbs down to Edina and constructing a new headquarters. Those are fun to work on. Those are a little bit bigger, but ordinarily it's the small mom and pop deals that I'm working on. And by the way, anybody that owns investments in a 401k or a pension plan, they have exposure to real estate. They just don't know it. They have REIT shares, and they have exposure to real estate. And anyone that has life insurance companies love to hold real estate because it appreciates in value, and they have a steady, usually, unless it's an office building, they have a steady asset that they can rely on, All right. I want to mention something about different types of tranches of gain that you might have. Land is not depreciable. You can't take tax deductions on the theoretical wear and tear of the dirt. This building is probably 39-year depreciable building. You will recoup your outlay for this building slowly over 39 years. Multifamily is depreciable over 27 and a half years. It's still a long depreciation schedule. That slow straight line depreciation over 27 and a half or 39 is typically called 1250 depreciation. Those are the reductions in your original cost basis. As the deductions are taken, you have a corresponding decrease in your basis. At the end of 39 years of writing down this building, your basis will have been whittled down to zero for the building. Now, there were some favorable court cases in the 80s where accounting firms sued the IRS and said, no, we should be able to go in with an engineer and do a cost segregation study. That wall, that accordion wall back there is not a load-bearing wall. It's not a structural requirement of this building. It is nice, but it's not holding up the roof. We should be able to write that off over, say, a shorter period of time. The floor coverings are not long-term. The window treatments, specialty lighting, these fixtures should be written off like personal property is more rapidly. And so there's a whole industry of people doing cost segregation studies where they come in and analyze every facet of the building, aggressively writing off the components quickly. Those more rapid, accelerated depreciation deductions allow you to get more tax deductions quicker, but they generate 1245 gain because they push down your basis also. And the profits or gains that are derived as a result of that gain that's attributable to the rapid depreciation is called 1245 gain. Well, why do you need to know about these different types of gain? Because in a 1031 exchange, not only are you doing a like-kind exchange, real estate for real estate, but if you've also got the extra complication of 1245 gain, you got to make sure that what you're buying for a replacement property has enough 1245 components that you can match up the 1245 gains that were generated on your sale with new 1245 components over here. If you sell an agricultural building, a little 1 acre piece of land with a chicken coop or a grain silo or a hog, whatever they build for hogs, shed, that is shorter lived agricultural improvements. They're not like permanent long-term structures. And you get to write those things off fast. And unless you're really cautious about how you allocate value in the purchase agreement, you can have very little 1250 gain from the sale of the land and a whole enchilada of 1245 gain from the sale of this hog shed thing. And it makes it hard when you're searching for replacement property to make sure that you're getting enough 1245 components over here. What are some types of property that are rich with 1245? You know these truck places where the trucks come in and they get their gas and maybe they park overnight and you got these like temporary corrugated metal things. I don't know what those are called, truck stops. I guess those are rich with 1245. Some medical office buildings that have a lot of specialty medical structures and fixtures, those can be rich. Facilities that have a lot of electrical, fiber optic stuff, transfer stations and things like that, they have a lot of 1245. And of course, agricultural buildings, specialty buildings have a lot of 1245. You need to be cognizant of not only that you're doing a real estate exchange, like kind real estate for real estate, but you also have to be mindful of the types of gain that you're trying to defer. Otherwise, your client could be really bummed out when they thought they did everything right. They sold their relinquished property, bought a replacement property, it's all real estate. And then they're like, oh, you mean this raw land that I bought, this farm that I bought in Decorah, Iowa, doesn't offset the gains completely from the sale of my medical office building that I had rapidly depreciated with cost segregation studies? It is now 10:37, and I'm going to go right till 11 o'clock because I'm afraid of the Minnesota Department of Commerce. They scare me. I bet you they have their agents in here right now assessing whether or not we're actually giving legitimate pedagogical content, or is this just some kind of song and dance sales presentation? So I'm going to go right till the razor's edge. And then at 11 o'clock, I'm going to bring out Joe and Kathleen again to let them talk about their products and services too. Let's say that you own a little business in the Minneapolis area, maybe over by the Wedge Co-op. That neighborhood has changed. It's now gentrified and residential. It used to be kind of an industrial area where manufacturers would build stuff and there were oil drums on pickup trucks, and it's just completely different now than it was 30 years ago. Your business may not fit that neighborhood anymore. Your stinky trucks and your manufacturing process just may not be conducive with the environment. And also the structure may be too small for your growing business. So many of these businesses that were doing industrial, light industrial, or semi-manufacturing are moving out of Minneapolis proper, and they're going to northern suburbs like Ramsey, or even further north, St. Cloud. And they're buying land and building new facilities that are more expansive and built to their specifications to allow them to do more business. They're selling high in Minneapolis, taking their tax-deferred dollars where their buying power is better, and they're building new facilities that will allow them to be more productive, more profitable, and hire more employees and expand their operations. A build-to-suit is a great tool to have in your tool belt if you want to not only defer the taxes, but build the replacement solution to your specifications. You can do a build-to-suit exchange under the safe harbor of Rev Proc 2037, but then you're capped at 180 days. The intermediary can hold that property for only 180 days. Or if you're on the wilder side, if you're a riverboat gambler, you could do what's called a non-safe harbor construction exchange. In a case called the State of Bartell in California, there was a drugstore operator that had a drugstore built into a strip mall. They were kind of like tucked in like a shoebox in rows. They were contained inside of a bigger structure. And they didn't want to be contained in that structure. They wanted to have a separate pad site. They wanted to have a standalone building like the CVS's and the Walgreens do. And so they hired an intermediary to procure that outlot on that pad site and to hold the property while the new drugstore building was erected and constructed and existing as real estate. And it took 17 months to get that structure in existence as real estate. And then the taxpayers sold the little strip mall location and received from the exchange accommodation title holder this product that had been curated for them, and they reported it as a 1031. And everything seemed fine until they got the audit notice, and they went to tax court, and the tax court judge sat on this decision for a long time, but eventually 100% held in favor of the taxpayer. The IRS got their clock cleaned. The IRS argued that this exchange accommodation title holder was just an agent of the taxpayer, the patsy. They were holding as an accommodation. They were just an extension of the taxpayer. The tax court didn't buy that argument. They said, hey, this is a reputable company that facilitates exchanges. They act as an administrator day in and day out to facilitate exchanges. Under the Treasury regulations, it says the qualified intermediary is not the agent of the taxpayer, and the IRS lost across the board. Did the IRS appeal that decision to the Ninth Circuit Court of Appeals? No, they did not. Historically, the Ninth Circuit hasn't been real friendly to the IRS and has been, I would say, very generous to taxpayers. And so maybe they made a strategic decision not to appeal. But they did file a notice of non-acquiescence, which is basically being a sore loser and saying, I don't agree with your decision. We're not going to follow that in other circuits. So now what do we do with a non-safe harbor construction exchange that we're doing? We don't have the certainty anymore because it's not within the Rev Proc 2037 bright line safe harbor, but we have a ton of case law from before 2000. We have the State of Bartell case. If you have the gumption, the chutzpah, you can do a non-safe harbor parking arrangement and have your replacement property curated for you. Let's say that you own a $60 million apartment complex that you've owned for a long time and depreciated way down, but it was 1950 built. And it's got a lot of deferred maintenance. And it's maybe in a neighborhood that's not going to be growing in the future. And you would like to be in Jacksonville, Florida, in a $120 million apartment complex where you think values are going to climb faster because Jacksonville is growing more households than any other place in the country. So you say to your intermediary, I want you to go out and buy that piece of raw land in Jacksonville and hold it for 25 months while we erect this big construction project. And towards the end of that construction, I'm going to list my $60 million property in Mankato for sale. And as long as I'm within 180 days after the sale of my relinquished property, because you will have a forward 180-day clock ticking once the Mankato relinquished property sells, as long as you receive that curated, constructed property in Jacksonville within your time frame for your forward exchange, you're going to have a valid 1031, at least on the face of it. About a week ago, I got notified that one of our clients that we did a deal in Florida on a non-safe harbor construction arrangement is being now audited. And so I think audit activity is ramping up. I also got a notification that one of our clients that actually did a failed 1031 out of California, they didn't even report it as an exchange because it failed. They're being audited, and the IRS is asking for information about their failed 1031, which they didn't even report as tax deferred because they didn't achieve their parameters. So I do think that this might be on the increase. We already talked about building on land that's already owned by the taxpayer, that it's swimming upstream and it's contrary to the general trend. But there is a private letter ruling. Here it is. There's the link to the IRS website where it hasn't been revoked. They haven't taken it down. And so there is authority for constructing improvements on land that's already owned by the taxpayer by creating a separate and distinct estate. It's kind of like three-dimensional chess. You've got the fee title, and then you've got this another level called the leasehold estate. And on that estate, the constructed improvements will exist. Here's the citation for that California case where the IRS filed their notice of non-acquiescence. Let's talk about a little game that's been in the papers quite a bit. It's called basis shifting. And the IRS has been on a terror to stop basis shifting in a different paradigm under partnership law. They have been in the papers, they've been in the news, trying to stamp out abusive basis shifting games. But the original basis shifting game used to be done under Section 1031. Let's say that you owned a property in Roseville, Minnesota for 40 years. It happened to be called the Target store in Roseville, one of the earliest Targets ever opened up. And your basis is super low, but the value is high. And you recently built another Target store in San Diego for the same price, $40 million, which you have high basis on. What people were doing is they were swapping these stores, these properties, between their wholly owned subsidiaries. You can effectively move that high basis that you have in the San Diego entity and flip-flop it so that it moves to Minnesota. And the low basis goes to California. So that when you sell that Roseville store, now you've got a high basis and you don't have to pay any tax because you just flip-flopped them between wholly owned subsidiaries. To stop that stuff from occurring, Section 1031F was introduced to the code. One of the precepts of 1031F is that if the motivation for doing the related party transaction is to avoid the imposition of the tax, then the exchange is invalid. Your Honor, please tell me the distinction between the legitimate intention of wanting to defer one's gains and the illegitimate intention of wanting to avoid the imposition of the tax. I don't know if you can discern a difference. These related party rules were designed to stop abuses that were pretty much happening by the big mega corporations. But then the IRS applied these same rules across the board to even little mom and pop transactions. There was a son who identified 3 properties. The third one was his mother's home. Option number 1, fell out of bed. Option number 2, fell out of bed. Son's last choice was to acquire the last identified property, which is his mother's home. Well, son did not pay any taxes because he deferred them through an intermediary doing everything correctly. Mother didn't pay any taxes either because it was a principal residence. That was the perfect storm for the IRS. What? Related party transaction and nobody's paying any taxes. This has got to be a scheme to avoid the imposition of the tax. And they went after the taxpayer and the IRS won. Totally muddying the waters, like what is permissible? I mean, guy didn't really have a nefarious plan to avoid the imposition of the tax. He just wanted to complete his exchange. And he bought the last property that was on his identification list. So the IRS has been pretty tough on mom and pop investors. But more recently, there have been a bunch of private letter rulings issued by the IRS that seem very easy and nice. Let's say that property is distributed out of a trust to you and your brother 50-50. You and your brother own White Acre and Yellow Acre 50-50. And you are a Minnesota Vikings fan and your brother is a Packers fan. And because of that dispute, you barely even talk to each other anymore. And you could not conceive of continually owning property jointly with this Packer fan brother of yours. Brothers are divided. The family is in chaos. There's only one way to solve this, and that's to do a simultaneous horse swap where you give up your share of Yellow Acre to your brother, and he gives up his share of White Acre to you in a simultaneous swap. Recently, the IRS has said in private letter rulings that these inter-family related party transfers are okay if they are done shortly after the distribution of the property out of the trust to consolidate 100% of a parcel in a particular taxpayer. So that seems like a winner. There have been other favorable private letter rulings in the context of sales and transfers after distributions out of estates as well. We do a lot of family related party transactions here in the Midwest because if you're a farmer and you want to buy that productive farmland that's right next to your home farm, invariably you're buying it from your mother or your brother. And you have synergistic reasons why you want to buy that, but you also have an emotional connection to that land that's been in your family for 3 or 4 generations. Your family's blood is in that soil. Let's play the John Cougar Mellencamp, you know. You want that land, but not only for historical reasons, but for emotional connections to that earth and the economic synergies. So I think that we can do a related party transaction, but that mother-son deal does still muddy the waters. Accountants in rural Minnesota are accustomed to filing the Form 8824 that specifically asks you to disclose if you bought or sold directly or indirectly from a related party. So you're going to have to tell them. And then if you do a related party deal, they require you to give a narrative, a written explanation of why this isn't part of a scheme to avoid the imposition of the tax. All right, well, we want to buy the adjacent farm because it's closer. Our equipment and our gas prices will be lower if we buy that, don't have to farm across the county. And there's a historical family tradition of farming that land that we want to keep it. And the quality of that soil next door is better than the productive soil that's elsewhere. So we come up with all these written reasons, we throw it in there. And I've never seen a farm-related party transaction get attacked by the IRS. Personally, I haven't. I've heard tell of it happening, but I've not seen it. Are there any other questions? I want to make sure that anyone's golden nuggets. I'm not going to take you, sir. You've had quite a few opportunities to speak. I want to make sure that other people have an opportunity. No offense.
Yep, coming.
What if I want to sell an industrial building and buy an apartment building, and I want to reside in one of the units?
I don't like the idea of crossing the streams. Have you seen the movie Ghostbusters where they said, don't cross the streams? Don't cross the streams. Why be cute? You know, go buy a condominium or something and live elsewhere. There's also an expression that you don't want to live where you. So, yes, theoretically, you can mix the use of the replacement property. Like I had this question. The man wants to buy a farm. The farm has like 78 tillable acres and a farmhouse that's really nice. And I said to the man, look, you could do that and like use 1031 monies and non-1031 monies to buy this farm. But I'd really like it if you could separate that into two distinct transactions and unify the 1031 money so it's only used to buy the tillable acreage under one purchase agreement and use non-1031 monies to buy the farmstead. He's like, well, no, it has one PID. I said, well, write up a purchase agreement that says the seller will make all reasonable best efforts to subdivide the property into two PIDs. And he's like, I don't know if that county will allow us to subdivide the property the way we want to. Well, that's why it says all reasonable best efforts will be made to subdivide it. But I don't love the idea of mixing the money. But yes, you could theoretically do it. But what happens when a revenue agent looks at that return and they see that your voter registration, your tax returns, your driver's license also correlate to the address of the property that is purportedly your replacement property? Do you think that might be part of the secret sauce that they use to decide who they audit? I do. So I just as soon not have that bad optic, personally. Don't pull the tail if you don't have to. We have to use a microphone, though, whoever's got it. Go ahead, sir.
Hey, Jeff, what happens in the case of establishing value for a property? So let's say we have a lease that's a 5-year lease, and in there's the right of first refusal to buy it. And let's say in that lease, it says, okay, on day one, I can buy this property for $2 million. But let's say by the time they sell it in the lease, the property is actually worth $2.5 million. So they're actually buying it at a discount. What establishes value? The actual purchase agreement, or does there have to be an appraisal that's done?
Yeah, it's the thing about value. It's like so subjective. I would say that the IRS would probably take the position that the value is the lower of the two because that's what the buyer paid for the property. And what they paid for the property is the value. We did a deal where our client bought a replacement property in downtown Minneapolis, and they needed to buy a more expensive property. So as part of that, we also held it in a parking arrangement for a construction exchange. And we attached that building to the Skyway system by building a sky bridge. The costs to construct the sky bridge were not that much. But then the client said, we want to have all of the blue sky that goes along with that, the increased traffic, the whole thing. So they hired an appraiser to establish a value or support a value that was even higher than what they paid out for the actual costs of constructing the improvements. I think the IRS, again, would prefer to have the lower number used, the amount that was actually paid for the improvements, but probably a judge would take the higher value because it truly did enhance the value of the property once it was connected in the Skyway system.
All
It was
right,
blue
Jeff,
sky
up with
there.
the state of Minnesota. You hit your 2 hours. Very impressive. We have room for another 30 minutes, I think, maybe more. I don't know.
Here's what I want to do. First, I want to have Matt Thompson thank everybody and say a few words about US Bank and your many services. Then I want to bring Joe up again one more time, and then I want to bring Kathleen up if she's here. So can we do that real quick?
It's your call, Jeff.
Let's do it.
Party. Well, I kind of gave my commercial already, but I will tell you, I've done 1031s personally myself. I've worked with them.